So, in the introductory episode, we had discussed the concept of amalgamations, absorptions, and external reconstruction. Right in the very first episode of amalgamations, we had tried to understand the difference between these three terms. Because a lot many times in the question, they may say amalgamation, sometimes they may say absorption, sometimes they may say external reconstruction. So in the introductory episode, we had distinguished between these three items. Later on, we understood that the title of Accounting Standard 14 is Accounting of Amalgamations or Accounting for Amalgamations. And at that time, we understood that all the three items are treated in the same way under the Accounting Standard 14. It means under AS 14, there is no difference in the accounting of amalgamation, absorption, or external reconstruction. The accounting remains the same. Instead, Accounting Standard 14 is identifying two types of amalgamations. So if I apply AS14 is identifying two types of amalgamation. One will be known as amalgamation in the nature of merger. This is the first type of amalgamation. Amalgamation in the nature of merger. Another is considered to be amalgamation in the nature of purchase. So these are the two types of amalgamations which are identified under Accounting Standard 14. The point that I am trying to make is amalgamation, absorption, and external reconstruction. All the three are different. But as far as AS14 is considered, they are all part of amalgamation. So when I say amalgamation under AS14, it will include amalgamations, it will include absorption also, it will include external reconstruction also. So when we are solving questions, we are not supposed to differentiate between amalgamation, absorption, or external reconstruction. Instead, when you are solving questions, you have to distinguish between amalgamation in the nature of merger and amalgamation in the nature of purchase. Now, there are five conditions. Five conditions. If all conditions are fulfilled, all conditions are fulfilled, I mean all the five conditions, then we consider it to be amalgamation in the nature of merger. If any one condition is not fulfilled, then it becomes amalgamation in the nature of purchase. For example, five conditions are there, you satisfy four conditions, still it is amalgamation in the nature of purchase. Five conditions are there, you satisfy only three conditions, two condition, one condition, every time it will become amalgamation in the nature of purchase. All five conditions are satisfied, all, then it is amalgamation in the nature of merger. We have to distinguish between amalgamation in the nature of merger and amalgamation in the nature of purchase. The reason being that the accounting as per AS14 will be different. Do you know what that means? Again, at the risk of repeating myself, amalgamation, absorption, external reconstruction, that difference is not important at all as far as AS14 is considered. In AS14, whenever we read the question, we should be able to identify whether it is amalgamation in the nature of merger or is it amalgamation in the nature of purchase. Because the method of accounting under AS14 will depend upon the type of the amalgamation. So the question that arises is that which are these five conditions? Here it is. These are the five conditions. If all of these five conditions are satisfied, then we will consider it to be an amalgamation in the nature of merger. Okay, which are the conditions? Look at the condition number one. All, right? Concentrate on this word, all. All the assets and liabilities of the transferor company, all the assets and liabilities of the transferor company before amalgamation, they become the assets and liabilities of the transferee company. See, transferor company and this is transferee company. Transferor company will be understood as selling company. Transferring will be understood as the purchasing company. So what they are suggesting is all the assets and all the liabilities of the selling company will be taken over by the purchasing company. You get it? So visualize the asset side of a balance sheet. You are having fixed assets, you are having current assets. Even in fixed assets, you will have tangible assets, intangible assets. Everything will be taken over by the purchasing company. Okay, every asset will be taken over by the purchasing company. Similarly, every liability will be also taken over. Every liability, even that also will be taken over. Right? So you are having current liabilities, you have long-term liabilities, short-term liabilities, everything is going to be taken over. So that is the first condition. So the moment you are saying, for example, the moment you are saying that purchasing company will take over the assets of the selling company except land. Let us say there is land in the books of the selling company. Purchasing company suggests that we will take over all the assets except land. This will become amalgamation in the nature of purchase. Why? Any one condition is not satisfied. It is amalgamation in the nature of purchase. Every asset has to be taken over. So if you are taking over assets on selective basis, if you are taking over liabilities on selective basis, then it will not become amalgamation in the nature of merger. Okay, let's see the second condition. Yes, in second condition, they are saying shareholders holding not less than 90% of the face value of equity shares of the transferor company, other than equity shares already held in immediately before the amalgamation by the transferee company or the subsidiaries or the nominees. Forget about that. They are saying become equity shareholders of the transferee company. Transferor company, that is your selling company, and transferee company is the purchasing company. What they are saying is shareholders holding not less than 90% of the face value of the equity shares of the selling company will become equity shareholders of the transferee company. So let us say if you are a shareholder of the selling company, then you will also become shareholder of the purchasing company. So this is what they are suggesting. And it should be 90% of the face value, not the 90% of numbers. For example, if 1 lakh shareholders are there, 1 lakh shareholders are there, and then let's say 95,000 shareholders decide, okay, we will become shareholders of the purchasing company, then this is going by number. We have to not go by number. We have to go by the face value. Okay. In short, what we are saying is that whoever is a shareholder of the selling company should also become shareholder of purchasing company, and not just a shareholder. Everything is in terms of equity shares. Okay. Equity shares. So you are an equity shareholder of selling company. You should also become equity shareholder of purchasing company. Think for a moment. How is it possible that an equity shareholder of selling company will also become equity shareholder of purchasing company? This is possible only if the purchasing company settles the purchase consideration by issuing equity shares. See, only then this is possible. Otherwise, it's not possible. For example, let us say the purchasing company has decided to take over the selling company for cash. Okay, so you are an equity shareholder of selling company. Purchasing company pays you in cash. If the purchasing company pays you in cash, then you will never become an equity shareholder of the purchasing company. You can become equity shareholder of purchasing company only if the purchasing company issues shares to you. So that is the continuation. Okay, that is the third condition. In third condition, they are saying that the consideration for the amalgamation receivable by those equity shareholders of transferor company who agree to become equity shareholder of transferee company is discharged by the transferee company by issue of equity shares in the transferee company. You get my point? You are a shareholder of selling company. I am purchasing company. I pay you in cash. If I pay you in cash, then you can never become equity shareholder of my company. You will become equity shareholder of my company only if I issue equity shares to you. So you are an equity shareholder of selling company. I will give shares of my company, purchasing company to you, and that is how the purchase consideration needs to be settled. So whoever is an equity shareholder of selling company, I have to settle them by issuing equity shares of the purchasing company. So this is how you will become an equity shareholder of purchasing company. But there is one exception. They say except that cash may be paid in respect of any fractional shares. In case if there are any fractional shares, then cash can be paid. So that's an exception over here. Think in this way. Think in this way. There is some shareholder XYZ. This shareholder has 116 shares of selling company. Okay, so you're having 116 shares of selling company. Purchasing company offers a share exchange ratio, let's say share exchange ratio of 1:5. So this is a share exchange ratio offered by the purchasing company. So I will take 116 and I will multiply this by 1/5. See, you are a shareholder right now of the selling company. I offer shares of the purchasing company. So now you will become a shareholder of the purchasing company. But my share exchange ratio is 1/5. So 116 I multiply by 1/5. This is turning out to be 23.2 shares. Okay, 23.2 shares of purchasing company. Now it is very natural that I cannot issue fractional shares. See, 23.2, what does that mean? 23.2. 23.2 means 23 shares. Zero point 0.2 will become a fractional. Now, fractional shares cannot be issued. I cannot issue fractional shares. So, what the accounting standard is saying is that, okay, give this person 23 shares. Okay, give this person 23. And when I say shares, I mean equity shares. Okay. So, what AS 14 says is that you give this person 23 shares of your company and zero point 0.2 share. Just a second. What it says is that zero point 0.2 share which is there, zero point 0.2 shares, this 0.2 shares we will settle in cash. This is the suggestion given in the accounting standard. So 0.2 share I will settle in cash. This is allowed. Okay. This is allowed by the accounting standard. The accounting standard says that no, you should be issuing only equity shares, only equity shares. But if there are any fractional shares, if there are any fractional shares, then no problem. For that, you can pay cash. So cash can be paid for the fractional shares. As I said in the earlier illustration, 23.2 was there. 23 shares can be issued, but how will I issue 0.2 share? So 0.2 share I will settle in cash. It will still be considered to be fulfillment of condition 3. Condition 4, that's a very simple condition. Business of the transferor company is intended to be carried on after the amalgamation by the transferee company. So we are not going to take over the selling company and then shut down the business of the selling company. No, you will take over the selling company and you will continue with the business of the selling company. And the final condition, condition number 5, no adjustment is intended to be made to the book values of the assets and liabilities of the transferor company when they are incorporated in the financial statements of the transferee company, except to ensure uniformity of accounting policies. Getting that? The first condition, if you remember, the first condition was every asset of the selling company should be taken over. And when you take over the assets of the selling company, you have to record these assets in the selling company in the books of purchasing company at their carrying amounts or at their book values. So let us say you are having plant and machinery, you have plant and machinery of 50 lakhs of rupees. So in the balance sheet of the selling company, you are showing plant and machinery at 50 lakhs. When this plant and machinery is taken over by the purchasing company also has to record at 50 lakhs only. You cannot change this value. Everything should be recorded at the book value. Not only the assets, even the liabilities. Every asset, every liability. So condition number one, every asset is to be taken over, every liability is to be taken over. And now if I read it with condition number five, every asset and every liability that you have taken over, you should record it in the books of the purchasing company at their book values. Yes, you can make adjustments for ensuring uniformity of accounting policies. And then they've given you an example also that if transferor company is following straight line method of depreciation, the book value of the assets of the transferee company will be revised by applying the written down method of depreciation. Actually, SLM and WDV is now no longer an accounting policy, they are accounting estimates, but still, this adjustment can be done. For example, this is the books of the selling company. You are showing 50 lakhs, but you have been charging depreciation as per SLM. Purchasing company has been charging depreciation as per WDV. So purchasing company can argue that if selling company was also following WDV, then what will be the plant and machinery? Let us say we realize that in that case, the plant and machinery will be 47 lakhs. Then purchasing company can record that at 47 lakhs. One may argue that the book value was 50 lakhs. You are not recording at 50 lakhs. You are recording at a value other than 50 lakhs. Yes, you are allowed to do this because this will bring about uniformity of accounting policies, isn't it? Your 50 lakhs is as per SLM and my figure is as per WDV. There is no point of adding to my figure of WDV your figure which is as per SLM. So I will ask the selling company, let's see if you follow WDV, what will be the book value? Then we realize it is 47 lakhs. Then I can record this at 47 lakhs. Comfortable? So very quickly again, two types of amalgamations are recognized in accounting standard 14. Amalgamation in the nature of merger, amalgamation in the nature of purchase. Fulfill all five conditions, it will become amalgamation in the nature of merger. Any one condition not fulfilled, it becomes amalgamation in the nature of purchase. Very quickly, conditions. Every asset, every liability of selling company should be taken over by purchasing company. Condition number two. At least 90% of the face value of equity shares holders of selling company should become equity shareholders of purchasing company. Condition number three. Whoever is an equity shareholder of selling company will now become equity shareholder of purchasing company because purchasing company will issue equity shares. But by chance, if there is any fractional share, then you can pay cash. Condition number four. Business of selling company should be continued by the purchasing company after the amalgamation. And the final condition number five. This is in continuation of the condition number one. Every asset, every liability will be taken over and recorded in the books of the purchasing company at its book value. Yes, if there is any adjustment necessary in order to bring about uniformity of accounting policies, then that adjustment is allowed.